So, chapter 4, we will be covering different types of life insurance policies and some of the most common terms that we will come across. So, starting off, other words for coverage. So, this word coverage, you will see a lot of it. It will be in many of the chapters, but you might see it written a couple different ways. So, word coverage, also known as death benefit, also known as face amount, also known as face value, also known as proceeds, all mean the exact same thing, which is ultimately what the person is covered for. So if I'm covered for $250,000 of life insurance, that is what is known as my coverage, also known as my death benefit, also known as my face amount, my face value, and the proceeds if I were to pass away. Now, next term is proof or evidence of insurability. So with this, they mean the exact same thing. Just make sure that you're aware of how it is written on the test or on the question because they can use either or. Proof of insurability or evidence of insurability. And what those mean is that you have to qualify medically, meaning you have to do a blood and urine exam. Okay. A blood and urine physical medical exam is what they're asking when they ask for proof of insurability or evidence of insurability. Next key term is attained age. So attained age says is your new current age when you renew your policy. So for example, let's say I am 30 years old right now. I purchase a 35-year term. When that 35-year term is up, and let's say I want to renew my term for another 10 years, at this point, I'm going to be 65 years old. So my attained age when I'm attaining the new term would be 65. Okay. And then lastly, on these words to know is cash value. You'll see this word a lot once we get into the chapters where it involves life insurance and cash value, the different types of policies. But cash value is just really just a fancy word for a savings. Okay. So we're going to cover a couple different types of life insurance policies like whole life insurance, universal life insurance, where what they do is they combine cash life insurance with a savings. Fancy word for savings is cash value. So now we will dive into the first type of life insurance policy, which is term insurance. So term insurance has three main key points that apply to term life insurance. So number one is that it is pure protection. On the test, you may see it written as pure death protection, which means that there's absolutely no savings to it. So there's no cash value. So term insurance does not have a savings attached to it. It is pure death protection, meaning if the person passes away, company pays out the death benefit. The second point is it is temporary coverage. So you're only going to have it for a temporary amount of time, right? A term. So it can be anywhere from 10 to a 35-year term that coverage will be for. And the third is that out of all the different types of life insurance policies, term insurance is going to be the cheapest, right? So the lowest cost, but it's gonna give you the highest amount of coverage. So lowest cost, highest coverage that you can attain. Okay. Now, first type of term policy is what is known as a level term. So level term is where the coverage and the premium do not change throughout the lifetime of the term, throughout the term. Okay, so if it's 10 years, the coverage and the premium are going to stay the same. If it's 35 years, the coverage and the premium are going to stay the same. So level just means that it's going to stay absolutely the same. Okay. Now, let me give you an example of that. So I'm going to draw on these different types of policies. I'm going to give you guys a little drawing example just to really help simplify and help understand them. So this is a level term policy. And let's say I purchase this at age 30 and I purchase a 35-year level term. So that means that it's going to cover me from age 30 until age 65, right? For 35 years. So when it's level term, remember the coverage, which let's say my coverage here is $250,000, is going to stay the same from the moment I purchase the policy to the moment the term comes to an end, right? My coverage is going to be 250,000. Now also the premium is going to stay the same. So let's say my premium is going to be $50 a month for this policy. That means that from age 30 until age 65, that same premium is going to be paid monthly. Okay, so level term coverage is going to stay the same and premium is going to stay the same. Now, going on to the next type of term policy is what is known as a ART. So abbreviated ART stands for annual renewable term. So if you just move these words around, annual renewable term, it just is a type of policy where the term renews annually. Okay, so the term is going to renew annually. So this technically is just a 1 year term because that 1 year term comes to an end, then it renews. Okay, so it says coverage is level. So the coverage is going to stay the same, but the premium increases annually throughout the term. Now, one main key point that I want to make here is that all term insurance policies have a level premium. So what that means is that the premium is never going to change with term insurance. It is always going to stay the same. Now, annual renewable term, it says coverage is level, but premium increases annually. It does, but it is still level because remember, annual renewable term means the term is going to renew annually. So for that year, let's say the person purchases at 30 years old, from 30 till their next birthday at age 31, that premium is going to stay level for that whole year, right? So every month they're going to make that same monthly payment until they turn 31. Now, once they're 31, their term renews. Why? Because they're now a year older. So their premium is going to go up. Then it's going to stay the same for that year. Once they turn 32, the term renews again. And now it's going to go up again. Okay. But for that year, the premium stays level. So you might see a question on this pop up where you just read it carefully because it'll ask which of the following does not have a level premium. And annual renewable term will be one of the options, but that is not the correct answer because the premium does stay level, but it's just for that 1 year. Okay. Now, the next type of policy is what is known as a decreasing term. So, decreasing term is where the coverage decreases annually, but the premium is going to stay level throughout the term. Example of this would be mortgage life or credit life. So here, let me draw you an example of this. What this is, a decreasing term policy, is typically purchased when there is debt or a mortgage, for example. So let me explain it this way. It might make a little more sense. So let's say I just purchased a home, and on that home I owe $300,000. my mortgage. I would purchase a decreasing term policy for $300,000 of coverage. Why? Because if at any point in time I die, that policy is going to pay off what I owe on the home. Okay. So here we go. So I'm 30 years old, and let's say I purchase my home on a 30-year mortgage loan. So I'm going to get a decreasing term policy for 30 years. So it's going to take me from 30 all the way to 60. At 60 years old, I should have this home paid off. My premium, let's say it's going to be $50 a month. And remember, the premium stays level for however long the term is. So from age 30 to age 60, my premium is going to stay the same, $50 a month. Now, what decreases is the coverage. So, for example, I have $300,000 when I start, but as I start to pay my home down, then my coverage is also going to go down. So, let's say in these 30 years that I have my loan, I pay off half of the house. And now on the home, right, 15 years in, I owe $150,000 on the home. So I've already paid off half the mortgage. My coverage, because it decreases with whatever the debt is, at that moment in time, it's going to be $150,000. So it's going to be the exact same as the debt or the mortgage is. Eventually, let's say I get to age 59, and now on my home, I only owe, one more year worth of payments. Let's say I owe $7,000. My coverage is going to be also $7,000. So if I die at that moment and I owe $7,000 and 52 cents, then that policy, that decreasing term policy, is going to pay out $7,000 and 52 cents. It's going to pay out exactly what is owed on the debt or whatever is owed on the mortgage. Not a penny less, not a penny more. Okay, the exact same amount. Eventually, or let's say I make it to age 60 and I pay the house off. So now on the home, I owe zero. Home is paid off. This policy is now at zero, and then that's where the term ends and that policy gets canceled. Okay. But remember, decreasing term coverage decreases as the debt is decreasing. Alrighty, so next is an increasing term policy. So an increasing term policy is the exact same thing as a decreasing term, just instead of the coverage decreasing, the coverage is going to increase. Okay. So coverage is going to increase annually, but the premium, once again, also stays level. So coverage increases and premium stays level. So how does your coverage increase? Is by technically whatever you're paying on a yearly basis in premiums, they add to your coverage. Okay. And they're also known as return of premium policy. So you may get a question on the test that will ask, what is an example of an increasing term policy? And the answer would be a return of premium, or vice versa. They may ask, in what is a return of premium rider used? And it is a increasing term policy. Okay, so just remember those go together like peanut butter and jelly. So increasing term, return of premium. Okay, they're going to go hand in hand with each other. Okay, and now just finishing up here with term insurance is the renewable provision and the convertible provision. So here there's two different types of provisions. When your term comes to an end, right? So let's say that 35-year term is coming to an end, there's two options that you're going to have, or two provisions. The first one is the renewable provision. So when it's a renewable, it means you're going to keep the same type of policy, which in this case is a term policy, and you're going to renew it for another term. So here you're going from term to term. Okay. So you're renewing it from one term to another term. And this is, think about it at like auto insurance. Auto insurance, when your 6 month policy is up, you can renew it for another 6 months, right? You don't have to do all the paperwork all over again. You just renew it. Same thing here, right? You just renew the policy. Obviously, you're now going to be a little bit older, so they're going to quote you at your attained age. Okay. And then the second one is the convertible provision. So the convertible provision is where you're going to have to convert the policy from term to permanent insurance. And permanent, they're referring to whole life, universal life insurance, right? Coverage that's gonna you will have till you're 100 years old. Now, converting, so renewable, once again, you're renewing from term to term. Convertible is you're converting from term to permanent. And both of these options are done without evidence or proof of insurability. So you do not have to do a blood and urine exam in order for you to have to be able to renew it or to be able to convert it. Okay. So continuing on, we will jump into whole life insurance. Now, couple basics of whole life insurance. Number one, so what is whole life insurance? It is life insurance bundled with a savings. Okay, fancy word for it, cash value. So it's life insurance bundled with a savings. Now, five key basic points of whole life insurance. Number one is that it has a level fixed premium. So just like term life insurance, whole life insurance has a level premium, meaning it's going to stay the same for as long as the person has the policy. Number two, because it is life insurance, there is a face amount. If we go back to the beginning on words to know, face amount, also known as coverage, also known as death benefit, also known as proceeds, there's life insurance. The third is that there is a savings, which is known as the cash value. Number four is that it matures at age 100. So oh, once I'm done here, I'll give you guys an example of that, what they mean by it matures at 100. And then the fifth is that there are living benefits. So what they mean by living benefits is that because there is cash value, there is money that's being saved, you can borrow some of that money, right, by taking out a loan, which are living benefits, meaning it's money that you have that you can borrow from the policy while you are living. Okay. Now, a couple other generic names for whole life insurance is permanent insurance, ordinary life, or straight life. Three different names for whole life insurance. So let me give you guys an example of a whole life policy and how it works. So a whole life policy, once again, is life insurance bundled with a savings, right? With cash value. Okay. Now, let's say, for example, the individual purchases this policy at 35 years old. Whole life insurance is you are going to have this coverage for your whole life. And what they consider your whole life is up till age 100. So, from the moment you purchase the policy, when it is what is called straight life or ordinary life, you are going to pay from age 35 to age 65. Sorry, to age 100, which is 65 years that you're going to be making these monthly premium payments. So it's life insurance. So let's say life insurance's coverage is 100,000 and it has a savings. So it's going to also grow in cash value. meaning your savings. So you're covered for 100,000. Let's say your premium is $200 a month for this policy. So a portion of it is going to pay the life insurance, a portion of it is going to start going to go into the savings. So as you're paying this policy every single month for the next 65 years, when they say matures at age 100, it means that what you've accumulated in this cash value will grow to what your coverage was, the $100,000. So now the life insurance coverage cancels out, but now they're going to cash you out the $100,000 that you accumulated. That happens when you hit age 100. Okay. So it's going to mature at age 100. Another word that they may use is it endows at age 100. Okay. So that is straight life. So just think from the moment you purchase this policy, you're going to pay straight to 100 years old. Now, next type of whole life policy is what is known as a single premium policy, single premium whole life policy. So single means one, and premium means payment. So a single premium payment, whole life is where you're going to make a one-time lump sum payment. So a one-time lump sum payment. So for example, let's say, you know, husband and wife have life insurance coverage, husband passes away, wife receives $300,000 from his life insurance policy. She takes 50,000 of that and purchases a single premium whole life policy. So that means that she's buying it with a one-time lump sum payment of 50,000 and never making any other payment after that. But she's going to be covered till age 100. Okay. So it's going to mature before reaching age 100 and it'll expire. The coverage will expire at age 100. But biggest, most important thing to remember about a single premium whole life policy is that it is made with a one-time lump sum payment. Now, the next type of policy is what is known as a limited pay policy. Limited pay, just think of it as you're going to pay for it for a limited time. So you're going to make payments on it for a limited time. And an example of this would be a 20 pay life or life paid up at 65. Now, let me give you guys an example of a limited pay whole life policy. So remember, it is life insurance with a savings, with cash value. So let's say the person is covered for $100,000. They purchase this policy when they're 30. It's going to cover them till they're age 100. Their premium that they're going to pay for this policy, let's say, is $300 a month. So limited pay, whole life. So that means they're going to pay for this policy for a limited time. So one of the examples that they gave us was 20 pay life, which means that from the moment the individual purchases this policy at age 30, they're going to pay for 20 years till they hit age 50. At age 50, they're going to stop making payments for the policy, but it's going to continue to cover them till they're 100 years old. So if at any point in time they pass away before turning 100, they will receive the life insurance death benefit. Now, remember, it's a whole life policy, so this is also accumulating cash value. Okay? Limited pay. 20 pay life. Let's say they give you the example of life paid up at 65. So here, same thing. Person purchases it when he's 30 years old. It's going to cover him, or he's going to pay for it up to age 65, right? The example is life paid up at 65. At 65, he stops paying for this policy, but it's going to continue to cover him till he's 100 years old. Okay, perfect. So next one is what is known as an index whole life. So index, or you may see it written as indexed with the ED at the end, indexed whole life is a life insurance policy, whole life. Once again, it's going to cover you till you're 100 years old, but the savings portion of it, the cash value portion of it, is directly tied to an equity index like the S&P 500. So an example of that would be that S&P 500 stands for Standard and Poor's 500, which are, just think of it, 500 companies that are in the market, right, that are being invested in. So an index whole life policy, the cash value is directly tied to that index, right? The market. Just think the stock market. So if the market's high, then your money's going to grow. If the market's low, then you're at least going to receive a guaranteed minimum interest rate. Okay, and finishing up here with the different types of whole life policies is what is known as a MEC, a MEC, and that is an abbreviation for a modified endowment contract. So what a modified endowment contract is a whole life policy. So back in the day, just think of it this way, back in the day, whole life policies, meaning life insurance with the savings, people would overfund the savings, meaning they would put more money into the savings than they were supposed to have within a certain amount of years. Because if we go back to whole life, the ordinary life is you're supposed to have $100,000 of coverage, sorry, $100,000 of cash value when you hit 100 years old, not before that, because you're supposed to accumulate whatever your coverage was by the time you hit 100 years old, and then they cash you out that 100,000. So back in the day, people would overfund them, meaning if someone, purchased it at 35 years old and let's say they owned Amazon or Google, and they put $100,000 in the first year, then that raised a red flag. Why? Because they overfunded the policy. They weren't supposed to have $100,000 in the policy until they turned 100 years old. So how is it that they have $100,000 in the first year? So what ended up happening was the IRS, they created what was known as a 7-pay test. So what this 7-pay test is where the IRS is pretty much going to look at that policy to make sure that it's not being overfunded. Now, if it fails a 7-pay test, meaning they put more money in to that policy in those first 7 years, then that policy now becomes a MEC, right? It becomes a modified endowment contract, which what that means is that now it gives the IRS the okay to go tax that money. And basically, there's a 10% penalty for not passing that test. Now the IRS can go and tax that money. So on the test, if you see MEC, typically the answer will be it failed a 7-pay test. Or in the question, it says it fails a 7-pay test. What is it considered? It is considered an MEC, right? A modified endowment contract now. Okay, perfect. Now we will go into the flexible premium types of policies. So remember, term insurance and whole life insurance are the two types of policies that have a level premium, meaning the premium stays the same. These types of policies have flexible premium. So if you think of something that's flexible, just think it can go up or down. Okay, you can change it, right? You can pay one amount you can pay a lower amount. So, first type of policy we're going to talk about is what is known as universal life insurance. Universal life insurance, like whole life insurance, is two things bundled together. So it is life insurance that is bundled with a savings. Now, for test purposes, it's known as cash value, but for test purposes, if they're referring to universal life insurance, they'll refer to it as a cash component. If they're referring to whole life insurance, they'll say cash value. Okay. Now, in universal life insurance, the life insurance part of the policy is what is known as ART, which, if you remember, that stands for annual renewable term, which is a term that is going to renew every year, meaning the cost of the insurance gets more expensive. Okay. So universal life insurance, and a cash component, a savings. Second part of it is that it has a flexible premium. So what do they mean by a flexible premium? Is that you can either pay the minimum premium, minimum monthly premium, or you can pay the target premium. Okay, so you can pay the minimum premium or you can pay the target premium. That's why they say it's flexible, because you can either pay the minimum or you can pay the target. Now, the third part here is there's two death benefit options. So this as well, it applies to whole life insurance, but for test purposes, if they're referring to anything as far as death benefit options go, they're referring to universal life insurance. Now, option A is what is known as a level death benefit. Okay, option A or option one is a level death benefit. Here, meaning you're only going to get one. Option B is known as increasing. So you're going to get both. Now, for test purposes, just I won't break down exactly how both of those work, because all you need to know is option A is a level death benefit with the IRS corridor, and option B is increasing. Okay. And there you can also partially surrender that policy. Okay. Now, next is variable universal life insurance. Now, variable universal life insurance, what they're referring to, it works the same as universal life. The only thing that's variable, meaning just think it can vary, which once again means it can go up or down. The money invested, right? So remember, there's indexed whole life, there's also indexed universal life, which that money, the savings portion of indexed universal life, is directly tied to an equity index like the S&P 500. A variable universal life policy, the money's going to be invested into a separate account. Number two is that there's no security, meaning there's no guarantees, because it can vary. So it can go up or down at any time, meaning you can win big, right? You can have big gains, or you can also lose it all. So there's no security, there's no guarantees on your money, and there's also a securities license that's required. So any type of variable product that's being sold, a securities license is required in order to sell that type of life insurance. Now, we'll go into specialized policies. So here with specialized policies, the first one is what is known as joint life insurance. So joint life, two main points you need to know about joint life insurance is number one, it's two or more people being covered on one policy. So two or more people being covered on one policy. Premium is based on average age. So how they're going to calculate the premium is based on both of those individuals' average age. So for example, let's say dad is, let's say 40 and mom is 30. You add both of those up, that equals 70. You divide 70 by two people, mom and dad, that equals 35. So their premium is going to be based on their average age, which is 35 years old. Not on dad being 40, not on mom being 30, but on 35. Now, most important thing to you need to know about joint life insurance is that joint life insurance pays out on the first death. So once the first person passes away. So here, for example, dad and mom are both covered. Dad passes away, it's going to pay out the life insurance proceeds to mom. Okay, so it pays out on the first death, even though both of them are covered. The second the second type of specialized policy is what is known as survivorship life. So survivorship life is also based on two or more people being covered. It is also the premium is based on the average age. But the biggest difference between the two here is that with survivorship life, it pays once the survivor dies, meaning once the second person dies, right? Or last to die. So here, for example, dad and mom are both covered. Dad passes away. It doesn't pay out anything to mom. Then mom passes away. Now it's going to pay out to the son. Okay. So it doesn't pay out until the last person dies. Next type of policy is what is known as a juvenile policy. So a juvenile policy is written on the life of a minor. So it is not purchased by a minor. It is not bought by a minor. A juvenile policy is written on the life of a minor. So this is obviously a juvenile, someone that's below 18 years old. Technically, they don't work yet legally, so they cannot buy life insurance themselves. So a juvenile policy is written on the life of a minor. Now, it also has what is known as a payer benefit rider. So, payer benefit rider is the payer of the policy, let's say mom or dad. Let's say dad in this case has purchases a juvenile policy for his son. Dad is the one paying for that policy, but dad becomes disabled or dies. This payer benefit rider, because dad was the payer and he was disabled now or he died, the company is now going to take over paying for the policy until the child reaches age 21 or 25. So the child will still be covered with the life insurance, but up until age 21 or 25. Okay. All right. Next is mortgage life. So mortgage life, and this goes back to the decreasing term policy that we talked about. That is what mortgage life is. It's a decreasing term policy that is going to decrease its coverage as the mortgage is decreasing, or also known as credit life, or you also may see it written on the test as mortgage redemption. You think mortgage, it has to do with the home. So you're paying off the home. Decreasing term, if the person passes away, is going to pay out so that the mortgage gets paid out, gets paid off, not paid out, gets paid off. All right, next and finishing up here is a family policy. So a family policy is a policy where the whole family will be covered on one life insurance policy. Okay. So family is on one whole policy. Here, the breadwinner is as a question is written, the breadwinner will be covered with whole life insurance, and the rest of the family, meaning the spouse and kids, will have term riders on them. So the breadwinner will have whole life, and the family will be covered under the same policy under term riders. Now, the children will be covered till age 21, and the spouse will be covered until age 65. So, kids until 21, and the spouse until age 65. At that point, they can obtain their own policy themselves without having to do without having to show evidence or proof of insurability. Okay. And with the kids, they're covered up to age 21. But the kids, any child that's born after the policy is in force can automatically be added on to the coverage there. Now, finishing up chapter 4 here is policy replacement. So it says when an agent wants to replace a policy, it should be because a plan offered has better benefits. If not, it's considered unnecessary. But a signed statement, in other words, a signed notice regarding replacement must be signed by the client, and that is sent to the other company, whichever company it is that their policy is being replaced. But you must get a notice regarding policy replacement. Okay. And now it's added onto the application, right? Done electronically. So it's just literally a box that is checked. Okay. Awesome. So that is chapter 4, the different types of life policies. So please make sure to go back and view this as many times as possible just to get as familiar as possible with these. Beauty of our business and what we do is all we do is level term insurance, right? You don't need to know about any of these other types of policies. Why? Because we don't market them because they make no sense to a family when you can just get level term and you can invest the difference, right? But for test purposes, you do need to know how these work so that you're familiar with them. And obviously, as you come across clients and people that have these, you're able to explain to them how it is that they work.